Hello, welcome. In today's video, we will analyze Bombay Stock Exchange Limited, BSE Limited. We will look at the company's profile first, and from here on we will go into analyzing the company's financial statements, that is the profit and loss account, balance sheet, cash flow statement, etc. And since this company does not have any peer group with whom we can compare this company, we will move on and look at the graph and the intrinsic value calculation. But before that, a disclaimer is necessary. The information that is contained in this video is not intended or shall not be understood as a financial advice. I am not an accountant or financial advisor, and the information contained in this video is not a substitute for financial advice from a professional. I have done my best to ensure that the information provided in this video are accurate and data is extracted from reliable sources. I have done my best to provide valuable information to the investors so that they can make their own informed decision. This is an educational video. Regardless of anything, nothing available on or through this video should be understood as a recommendation or advice. Having said that, let's move on and look at the company's profile. We will look at the different lines of business that this company has. It has basically four main groups of businesses. One is the trading and clearing business. The second is the distribution. Then third is the services to corporates and other services. Trading and clearing includes equity, debt, derivatives market, currency derivatives, commodity derivatives. In terms of distribution, it does mutual fund distributions, book building services for IPO, new bond platforms. It provides services to corporates in terms of equity listing, listing of debt securities, and mutual fund listing. Other services include data feed, index services, software services, and training services. It receives revenue through all of these different services. Let us look at how the equity cash has performed as a segment of the business. In fiscal year 14-15, the average daily turnover, that is in millions of rupees, was 35,179 million. This is the amount of turnover, buying and selling, that happened in FY 14-15. The maximum it reached was in fiscal year 17-18 at 44,000 million. In 18-19, the average daily turnover dropped to around 31,274 million, the lowest in these years. For 9 months ending fiscal year 20, that is 3 quarters, data shows that the total average daily turnover was approximately around 25,539 million rupees. This is the amount of buying and selling that has happened in the equity cash market. This is even lower where it was in 9 months ending FY 19. If we look at the transaction charges, that is how much income it received through these turnover in millions of rupees, in FY 14-15, on a turnover of 35,179 million every day, in total it received around 48 crores from equity cash segment. That increased to around 144 crores in 17-18 and has now dipped further back to around 80 crores in FY 18-19. If we look at the 9-month total ending FY 20, the total income received was around 51 crores. If you look at the currency derivatives performance, average daily turnover in FY 18-19 was around 30,270 crores of daily turnover. Whereas in the 9-month ending FY 20, that turnover has slightly reduced to around 29,058 crores every day. We see an upward growth of around 39% in the daily turnover. So the more the turnover, the more the transaction charges. At the bottom we see the transaction charges that was received through currency derivatives segment. In FY 18-19, company received around 7.5 crore rupees through currency derivatives. That has further now dipped in the 9-month ending FY 20 to around 4.9 crores. So here also we see a reduction in the amount of income it is generating through currency derivatives. Although the amount of transaction on a daily basis is going up, the amount of income it is receiving is going down. If you look at the commodity derivatives, that is trading in gold, silver, copper, oil, and cotton seeds, etc., turmeric, then average daily turnover has been dropping. In quarter 3 FY 18-19, the total turnover was of 2,818 million. which has now dipped to around 1,678 million in third quarter FY 19-20. The company has a mutual fund platform as well. It has 40 mutual funds registered. The number of registered investors are around 28.4 million. The amount of active systematic investment plans have been steadily increasing. In terms of listing fees, it received around 188 crores in FY 18-19 as listing fees, whereas in 9-month ending FY 20, that is up till December 2020, 3 quarters ending December 2020, the total fees received was around 138 crores. So we can see an upward trend up till 18-19. There is a slight pressure going towards FY 20. If you look at the book building and other services, that has contributed around 25 crores in FY 18-19, and in the recent 9-month ending FY 20, the total income has further dropped to around 16.3 crores. Let us look at the consolidated profit and loss account. I may not go through all of them. I'll selectively go through individual line items, and only for FY 18 and 19. Transaction charges generated around 113 crores for the company. Treasury income on clearing and settlement funds contributed around 30 crores to the revenue, and other security services contributed around 26.9 crores. The total of the three is security services, which generated in total 171 crores. Services to corporates and other operating income contributed around 213 crores and 65 crores. That is, revenue from operations in total generated around 450 crores. Income from investments and deposits generated around 202 crores. This is the investment activity that the company has been doing. Other income has generated around 16 crores. So total income generated in 18-19 was 668 crores. If you look at the 9-month ending FY 20 and compare it with 9-month ending FY 19, we see that it has marginally dropped from 497 crores to 474 crores. The total operating expenses have slightly increased from 307 crores to 336 crores. Finance cost is very low in FY 19 at 9 million, whereas depreciation is 51 crores. Finally, if we look at the net profit from total operations, it stood at around 199 crores. Comparing the 9-month FY 19 with 9-month FY 20, that is 3 quarters with the 3 quarters ending FY 20, we see a marginal drop from 147 crores to 123 crores. Let us look at the consolidated key performance indicators. In FY 14-15, total revenue generated was 624 crores. Against that, the profit earned was 129. In FY 18-19, the total income generated was 687 crores, and the profit against that was 194 crores. If you look at the 9-month FY 19 with 9-month FY 20 data, the overall income has dropped from 505 crores to 474, and the profits has dropped from 142 to 123 crores. Consolidated EPS in FY 18-19 was 36 rupees per share compared to 23.7 rupees in FY 14-15. In 9-month ending FY 20, the earnings per share has reduced to around 24 rupees. The company's consolidated net worth has been steadily increasing. In FY 18, the company's total net worth was 2,935 crores compared to 2,460 in FY 14-15. So it has not moved up that substantially, although it has been growing steadily upward. In 9-month ending FY 20, the net worth has dropped to around 2,445 crores. Next, let us look at the dividend per share declared and the payout ratio. The company has been paying out a substantial amount of its profits as dividend. In FY 18-19, almost 97% of the profit earned was paid out as dividend. This data is based on a standalone profits. Finally, let us look at the shareholding pattern. This company is generally controlled by trading members having 16% shareholding. Financial institutions are holding around 6%. Foreign direct investments, FIIs and FPIs are holding around 22% in this company. Others would include the public at 50%. So this concludes my brief analysis of the company's profile and what it does. Next, let us look at the financial statements of the company. So let's begin our analysis of the profit and loss account of Bombay Stock Exchange. The company's revenues or money coming through sales has been growing at 6.1% through the last 5 years from March 14 to March 19. The company has managed to grow its sales from 485 crores to 652 till March 2019. And in the last 3 years, the growth has slowed down to less than 1% from March 16 to March 19. In fact, from March 19 to the recent 12 months, it has gone into the negative by 3.86%. Average operating profit margin for 5 and 3 years have been above 30%. We can see that in March 19, it had earned 652 crores through sales, out of which its operating expenses were just 447 crores. That's a 31.5% OPM margin. Even in the recent 12 months, although it has fallen down further to 24.5, it is above the 15% margin that I have set as my benchmark. Although the sales have dropped, the expenses seems to have gone up from 447 crores to 474 crores. Other income is contributing around 86 crores, which is almost 13% of the sales. The company has a lot of investments, it seems, and that investments is generating other income for the company. And we can see an uprise in the amount of other income coming into the business through 16, 19 and the recent 12 months. Depreciation as a percentage of total sales is occupying around 8.3%. So over the years, we can see that the depreciation value and the percentage as well has been very flat as a percentage of total sales. Raw material cost would be zero as this company is into providing services. Employee cost would be substantial. March 19, employee cost occupied around 21% of the sales, and that has been steadily growing up from 17% in March 16. Interest expense is very low at around 2 crores in the recent 12 months. That's just 0.2%, and throughout we can see that the company has not paid any interest or finance cost, and therefore it means that the company doesn't have any debt on its balance sheet. Company's tax rate in the recent 12 months is quite low at 11 crores, which works out to around 6% of the profit before tax of 186 crores. We can see that the PBT has fallen from 223 crores in March 19 to 186 crores in the recent 12 months. This needs to be investigated as to why the company has paid just 6% as tax against its PBT. Interest coverage ratio would be very high as the finance cost is very low against the EBIT it is earning. Net profit margin stood at around 28% in the recent 12 months and has been above 20% throughout the years. On a total sales of 627 crores, the company has earned 175. In March 19 also we see a very high NPM margin of 30.5. On a total sales of 652 crores, the company's net profit stood at 199 crores. Although in the recent 12 months, the net profit has fallen from 199 to 175 crores. The average of the last 5 and 3 years in terms of net profit margin is very high at above 40%, whereas in the recent 12 months, that has substantially come down to 28 and way below its 5 and 3 years average. The net profit growth rate compounded over 5 years was at the rate of 8.1%. That is, from 14 to 19, it has gone up from 135 to 199 crores. And in the recent 3 years also we see a positive growth rate of 14.4%. In fact, the profits have grown faster in the recent 3 years. But we have to understand that from 14 to 16, the net profit had seen a fall of around 2 crores, and from here it has gone up. So we can take the lower of the two values of 8.1%. This is not bad considering that sales in the recent 3 years had seen less than 1% of growth rate. If we observe from March 19 to the recent 12 months, the net profit has seen a degrowth of around 12% from 199 to 175 crores. But we cannot make our investment decisions based on a single year. We need to look at the long-term picture of 5 and 3 years and then make our decision. Company's current market cap stands at around 2054 crores and way below where it was in March 19 at 3213 crores. Currently it is trading at around 3.3 times higher than its sales of 627 crores. Previously in March 19, the company's ratio stood at around 4.9 times. and that has substantially fallen down to 3.3 times now. Although I would want the market cap to sales ratio to be below 5 to 6 times, which it has throughout March 19 and the recent 12 months. Dividend payout, as we earlier observed in the company's profile analysis, was very high at around 91%. In March 19, out of the net profit of 199 crores, the company paid out 155 crores as dividend, which works out to a very high percentage of 78. Even in 16, almost 60% of the profits was distributed back to the shareholders. In 14, it was 30%. So throughout, we can see a very substantial portion of the profits being given out back to the shareholders. Price to earnings ratio currently stands at 10 times. For a share earning around 39 rupees, we are paying around 391 rupees, which is the current market price. That's a 10 times multiple and below my benchmark of 25. Even in March 19, we see a 16.1 times multiple against EPS of 37 rupees per share. We were paying 611 rupees. Even here it was not very expensive, but compared to 2019, in the recent 12 months, the price earning multiple has come down to an attractive 10 times. Let us look at where it was trading over 5 and 3 years period. We can see in the last 3 years it was quoting at around 15.4 times its earnings, whereas currently it is available at 10 times, which is almost 5x lower than its 3 years average. Moving on to the balance sheet analysis, equity share capital stands at around 10 crores in 2019 and has been flat at around that value itself. Face value has increased from 1 to 2 currently in March 19. Return on equity in March 19 stood at around 6.8% and has been very low throughout the years at below my benchmark of 15%. So on a total net worth of 2,936 crores, the company's profits were just 199 crores. Compare that to March 16 also, we see it was a very low profits of 133 crores against the total net worth of 2,523 crores. Here I would want the company's ROE values to be as high as possible, so that gives us confidence that on the shareholders' money the company is earning substantial profits. But we see that overall the company's ROE over the years had not gone above 7%. The average ROE stands at around 12.5%. The reason for it going above 10% is because in one of these years the company had earned an extraordinary or exceptional income, so that would need to be discounted. The values here have not been adjusted for exceptional or one-time gains. If we look at the amount of net worth the company has, based on that, the profit the company is earning is quite low. We will need to look at the ROCE value to get a better sense of it. The return on capital employed is also very low because capital employed is nothing but the net worth plus any borrowings. And since the company has no borrowings, then capital employed and the equity would almost be the same. So almost 2,936 crores of capital employed. On that, the EBIT also is not that high at only 224 crores. So that works out to around 7.6%. This is also below my benchmark of 15%. In the last 3 years, the average ROCE stood at around 14.2. 5 years it was 12%, so substantially lower over the long-term period also. Return on assets, that is on the total balance sheet size, how much was the profit being earned? So the company had a total balance sheet size of around 4,524 crores in March 19. On that the profit came to around 199 crores. That's a 4.4% of ROA. Compare that with March 16 and 14. The profits have gone up gradually and the assets have not increased that much over the years. Let us look at the debt to equity ratio. Here we have already seen that the company is almost debt free by March 19. In March 16 the overall debt was just 1 CR and that too was very low. The company's total equity base is 2,936 crores. But even earlier when we looked at all the written ratios, ROE, ROCE and ROA, we saw that the amount of equity or net worth the company has, based on that, it is not earning a substantial profit. Although based on the revenue it is generating every year, on that it is earning profits. But when we look at overall net worth, there we see a very low value. So we want to see that both on the net worth as well as on the overall sales or revenue, company is generating higher profitability. Company's equity is contributing around 65% in the total balance sheet size of 4,524 crores. Whereas the debt is zero, as we saw earlier. So the balance of around 35% is other liabilities. And if we see the percentage wise, it has been steadily increasing from 14 to 16 to 19. Gradually, the overall net worth has been steadily going upwards. The valuation ratio price to book compares the market cap of the company with its net worth. Here we see in the recent 12 month or the latest price to book ratio stands at 0.7 times, which is a discount that we are getting on the net worth. That is, the company's net worth currently stands at around 2,936 crores. Whereas the market cap has gone way below that at 2,054 crores. Earlier in March 19, the price to book ratio was 1.1 times, and even here it was quite reasonable, although in the recent 12 months we are getting it at a discount. This happens when the market participants don't feel that the company is worth what it is saying in its books. Since the company is debt free, the ratio debt to net profit will not make sense because the company has nothing to pay off as debt. In terms of net block as a total percentage of assets or balance sheet, stood at around 4.5%, which is a reasonable value. Earlier we saw in the balance sheet the amount of depreciation that was charged against the sales was around 8.1%. So based on this it seems reasonable. So the company's total assets are very low at around 4.5%. When we look at the depreciation that is charged on the gross block every year, this seems at a pretty higher rate of around more than 15%. In March 19, the depreciation being charged on the assets of 255 crores was 51 CR, which works out to around 20%. Seems a little higher and needs to be checked as to why the company is depreciating its assets at such a high rate. Mostly when the assets are intangible in nature, like softwares and everything, softwares or computers, they are depreciated at a much faster rate and their lifespan is also very less, and therefore it has to be depreciated at a faster rate. But if someone wants to investigate further, they can look into the financial statements. There is hardly any work of capital nature going on into the business in March 19. Stood at only at around 18 crores, a very nominal figure. Cash holding is very high at around 34%. So a very substantial portion of the total balance sheet is in cash at 1,548 crores. I generally don't like to see a very high cash holding in the company. Rather, I would want the company to put that money into investing activity which could earn other income for the shareholders. Here, if you see throughout March 14, 16, 19, the amount of cash holding has been above 1200 crores every year. We can see that company believes in holding a substantial portion of cash in its balance sheet. Moving on to the investments percentage, here we see another issue where the total investments of the company are very high at above 50% in March 19. Almost half of the balance sheet is under investments, and that investments would generate other income for the company. Earlier in the P&L account, when we were analyzing the other income, there we saw that almost 10% of the sales or revenue generated into the business was also coming from other income. So that was a substantial portion. And now here we see that company's investments are substantially higher at around 2,380 crores. Rather, throughout the years, we see that it has always been above 2,000 crores. More than 50% of the total balance sheet size is into investments. So this definitely needs to be investigated as to what kind of investments this company is holding or what kind of investments this company has done and how much it is earning on this investments. Debtors stood at a very low 1.1%. Only 50 crores has to be collected from the total balance sheet size from the customers. And throughout the years, it has always been very low. As a percentage of total sales also, in March 19, the customers from whom the company had to collect payment was just 8% of the sales of that year. And throughout it has been very stable at around less than 10%. This payment of 49 crores would be collected within 27 days in March 19, and it has been very flat at around less than 30 days. Current ratio is comfortable at 1.2 times, meaning the company's current assets, meaning those assets which the company can sell off in the current year and pay off the current liabilities or liabilities which it has to pay in the current year. So it is in a comfortable position, and throughout it has managed to increase its current assets against the liabilities. Inventory would be zero as this is a service-based industry. Moving on to the cash flow statement analysis. March 19, the company's total profits declared was 199 crores. Against that, the company had an outflow of 318 crores in terms of operating activity, and this needs to be investigated. In March 16 also, the company had an outflow of around 44 crores from its operating activity. Out of the profit shown of 133 crores, company had not received anything in terms of operating activity, and both of these years needs to be investigated before we can take a decision. We'll also need to look at the long-term trend of 5 and 3 years. Over the last 3 years, company had a shortfall of cash of almost 77%. So out of the total profits of 1,100 crores, company had received a very low profits of 260 crores. It would be better to look at the cash flow statement separately in this case. Let us quickly go through the cash flow from operating activities in the cash flow statement of 2019. Here we see that the profit for the year in 2019 was 19,417 lakhs. So I'll convert all these values into crores. So the total profit for the year was 194 crores. So after adjusting for non-cash expenses and non-operating incomes, we get the operating profit before working capital changes. So here we see, I'll read out the main items which are in double digit. So out of this 194 crores of profits in 2019, 29 crores had come through profit from associates, that is through its subsidiary. So that has to be deducted. This is not an operating income. 51 crores was removed out as depreciation and amortization expenses. So that gets added back. 23 crores were impairment losses on financial assets. So that also gets added because this is a non-cash expense. All gains of non-operating nature will be removed out. So net gain on derecognition of financial assets would be removed out. Net gain arising on financial assets measured at fair value would be removed out of 89 crores. Interest income would be removed out. This is not an operating income. Dividend income would also be removed out of 19 crores. So finally, after removing out or adjusting for non-cash expenses and non-operating incomes, we get 113 crores of operating profit before working capital changes. After doing for changes in the working capital, that is, company had to increase its trade receivables by 17 crores. Company paid off around 21 crores to its suppliers. A major outflow was in terms of other liabilities and other financial, which reduced the operating profit before working capital changes by 353 crores, and therefore we see a negative 277 crores of cash going out of the operating activity. In the previous year, the company's cash outflows through operating activity were 154 crores. Finally, company paid a tax of around 40 crores which got deducted, and the net cash outflow from operating activities was 318 crores. Let us also look at what kind of activity is taking place in the investment part of the cash flow statement. The company had invested around 61 crores in property, plant, equipment, intangible assets or capital work in progress, etc. These are basically intangible in nature. 749 crores went into investments in equity and debt instruments. So as we saw in the balance sheet, a major portion of the balance sheet was in the investment activity. Then we see 29 crores coming in from certificate of deposits. These are the payment it received. It also received cash from bonds and non-convertible debentures of 901 crores. 86 crores went into investments in fixed deposits. 207 crores were proceeds received from fixed deposits which they must have done in the previous year. Company also received an interest of around 86 crores and dividend received of around 19 crores. So the total cash generated from investing activity was 347 crores in 2019 against 236 crores going into investing activity in 2018. Going ahead, let us also check out the cash flow from financing activities. In 2019, the finance cost was a very small 87 lakhs. In 2019, company paid dividend and taxes of around 228 crores against 183 crores in 2018. Payment towards buyback which the company had done in 2019 were of around 123 crores, which was just 44 crores in 2018. Thus, the net cash used in financing activity was 352 crores in 2019. We see a net decrease in cash and cash equivalent from continuing operations of around 322 crores in 2019. So coming back to our graph analysis, when we look at the comparison of cash flow from operating activity with the amount of cash that has gone into or received from investing activity, in March 19, although the company's outflow from operating activity was 318 crores, it did receive inflows through the investing activity of around 347 crores. Same thing happened in March 16 as well. There was an outflow of 44 crores from operating activity and 164 crores of inflows from the investing activity. So cash flow statement is not very stable in that sense year on year. So when we club it together for the 3 years, the company had received 260 crores through operations and 206 crores through investing activity as well. In last 5 years, in total 63 crores of operating cash flow, but 741 crores through investing activity. And even in the last 7 years, it is very similar, 158 crores coming through operations and 848 crores coming through investing activities. So as we saw earlier, the company's cash holding and investing activity in the balance sheet is huge compared to its overall assets. Let us recap the valuation ratios. Price to earnings stood at around 10 times. Price to cash is negative because there is an outflow from operating activities in 2019. Price to book is trading at a discount and market cap to sales is at 3.1. So although price earning, price book and market cap to sales are at a reasonable multiple, the price to cash has gone into negative territory, which we already saw in when we analyzed the cash flow statement. Moving on to the quarterly P&L account analysis. Company has seen a degrowth YOY of 16.9% from 18 to December 19, from 173 crores to 144. Further on, from September 19 to December 19 also, quarter on quarter, it has seen a degrowth of 6.6%. If you look at the profits has seen a degrowth of around 9% YOY from 50 crores to 46. Whereas from quarter on quarter, there has been a growth, but this is not valid since already YOY there was a negative degrowth. So we consider the negative as the degrowth rate for the profits. Finally, let's look at the net profit margin on a quarterly basis. In December 18, the company earned 28.9% margin. September 19, it was around 23.8, and in December 19, it went above 30%. So on a total sales of 144 crores in December quarter, the company's profit stood at around 46. So this concludes my detailed analysis of the financial statements of Bombay Stock Exchange. Next, let us look at the graph and see where we can buy or sell based on relative strength index. Moving on to the graph analysis. The company was listed on 3rd Feb 2017 and we have the data since then. What has happened here is we don't have any support lines. On 9th March 2018, it had made a double dip in the sense that both the RSI indicator lines had fallen below the 30 line and therefore it was a buying opportunity. But since we don't have any previous support lines, these lines have already drawn based on the future support and resistance lines that is going ahead in the future. So ignoring the future lines, if we look only at 9th March here, this was the first time it had gone below double dip. We don't have the past support and resistance lines to use as a benchmark. So we have to see a price consolidation before we can buy into such scripts. So even assuming that we did buy at 774 in 2018, from there the RSI indicator had gone above 50, then again moved back below 30 on 19th October 2018. So from here on, there was a buying here again at approximately 628 rupees. The first buy was approximately at 774. The second buy was at 628. Again, since we don't have any past support and resistance line to use as a benchmark, we have to wait for the accumulation to happen. Again, we see a drop down, but before that the RSI indicator again had crossed 50 and fallen back below 30 by 16th August 2019. Here was the third buy at 449 rupees approximately. Next, moving on, we again see that RSI indicator went above 50 and now it has not given a double dip, so we don't buy until and unless the double dip has happened. So in today's scenario, if I want to buy at this range, I can buy here, provided that I don't invest a lot of my capital at this price point itself. I'll need to spread it out towards the downside. So in this particular case, we'll have to wait for the prices to fall at approximately 304 rupees. Currently it is at 376 rupees and today's date is 5th May 2020. And the current RSI levels are at 41 and 37. So we'll have to wait for the price to again come down to our level of 304 to buy into it. But before we decide to buy, we have to make sure we have understood the business model, the company's profile thoroughly, and we are very sure that we want to buy into this company. Only then we have to break up whatever investment we want to do in this particular company into multiple parts and invest it gradually over a period of time. So this concludes my technical analysis of Bombay Stock Exchange based on relative strength index and support and resistance lines. Do understand that this is not a recommendation, as I mentioned earlier in the disclaimer. This is the way that I would buy or sell based on my own individual requirements. Invest only if you feel that this company is worth your money. Otherwise, there are many companies which you can invest in other than Bombay Stock Exchange. Since we don't have the 5 and 3 years price, we will not be able to do the intrinsic value projection for Bombay Stock Exchange, and therefore I conclude my detailed analysis here. If you have any questions or queries or doubts, do let me know in the comment section. Don't ask me to project the prices, where the prices will be. I don't know where the prices are going to be in the future. My purpose is to buy good companies at the best possible valuation and wait patiently after I buy in a gradual manner, upside, downside, and spread out my risk over different price points, and then wait patiently for the prices to go up. If the company's fundamentals are good and we're getting it at a good valuation, there's no harm in waiting for a year or two to get a good returns on that investment. Having said that, thank you for watching this video. Dhanyavad. Namaste. Bala